Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, everyone. My name is Manpreet, and welcome to Through the Noise. Now, next week, we celebrate the festival of Holi. In India, the festival welcomes the arrival of spring, though anyone who's participated will know that the prospect of having bright colors thrown at one can polarize opinions. Now, the prospect of a brighter spring has been visible across several major economies in the Northern Hemisphere. Last week, for instance, we illustrated how economic data surprises were starting to turn positive for several major economies. For markets, though, the good news increasingly feels like bad news, with markets worrying about what this means for inflation and hence central bank policy. Most recently, for example, we had the stronger than expected inflation data in the US and in Europe. Now, to discuss why this may be challenging the market's earlier Goldilocks narrative, I'm joined by Rajat, who heads macro strategy at the CIO office. So, hi, Rajat. Welcome to the podcast. Spring is here, but Goldilocks seems increasingly absent. In your view, how does this impact the likelihood of a US recession?
Hi, Manpreet. Glad to be here. Yes, the stronger than expected US and Euro area inflation that you mentioned has challenged the Goldilocks outlook. By Goldilocks, we mean cooling inflation and no recession. This was what was the outlook that was prevailing at the start of the year, if you remember. While the strong data has likely delayed the start of a recession, we believe they have made a sharp downturn more likely over a 1 year horizon. This is because elevated inflation, against the backdrop of historically tight job markets, is likely to encourage the Fed and the ECB to push for higher for longer rates. Not surprisingly, Fed and ECB terminal rate estimates, estimated by the market that is, have jumped to almost 5.5% and 4% respectively, hurting stocks and bonds in February. Now, historically, most US recessions have been caused by excessive Fed tightening, with a lag, of course. Since 1972, for instance, we've studied this a bit deeper. A US recession started on average 24 months after the first Fed rate hike, if we exclude the 2020's pandemic aberration, of course. Also, a recession started on average 16 months after the US government bond yield curve inverted. By that we mean the 10-year yield has fallen below the two-year yield. Now, extrapolating these averages, there's a high chance of a US recession by the end of this year or early next year, because the Fed started its current hiking cycle, if you remember, in March 2022, and the US yield curve inverted last year in July. While the range of the expected start of a recession is wide, this time a recession is likely sooner than past averages, as the current Fed hiking cycle has been the second steepest in history, as we have been discussing for a while. And this is likely to provide a shock to economic activity. This is already visible, as you know, in the US housing and manufacturing sectors.
No, indeed, I think an interesting case for an economic recession there in the US. But for investors, can you remind us why this discussion of an economic recession is so important when considering one's investment stance?
Sure, the timing of a US recession matters, as equities have historically hit a cycle bottom only after a recession has started. Hence, we are likely to see new lows in US equity markets as a recession strikes probably later this year or early next year, and corporate earnings are downgraded further. This is the backdrop that I just painted. Uh, it really supports what our defensive investment stance, or the safe strategy that we had adopted, if you remember, in our 2023 outlook. It confirms our concerns that equity markets, especially in the US and Europe, are underpricing recession risks, and that the equity run up since October was another bear market rally, similar to the one we saw in the third quarter of last year. Hence, we would do a few things. First, fade the rally in US and European equities and take advantage of the elevated bond yields that are available today to rebalance towards income assets and high grade bonds. Second, within equities, rebalance towards China and basically Chinese equities. The upcoming National People's Congress, which starts tomorrow, is likely to set a healthy target for domestic consumer driven economic recovery there, which is going to be positive, we believe, for the stocks, for Chinese stocks. And finally, the dollar could see further short term upside as Fed terminal rates and US Treasury yields rise, but we would sell into that dollar rally as markets eventually start pricing in a US recession and Fed rate cuts. So we believe that the Aussie dollar is a good candidate for a rebound against the dollar on the back of the recovery in China that I talked about.
Thanks, Rajat. I think that that's quite a good set of opportunities to really dig into and act on. But I wanted to dig into the point you raised about the income opportunity because bond yields, of course, have started to rise once again, particularly so in the last couple of weeks. And last week, indeed, we discussed why we see this as a reopening of the window of opportunity for income investors. In the short term, do you believe the rise in US yields is now done and it's a great time to enter, or do you think they could still rise a little bit further?
Yeah, the U.S. 10-year government bond yield, or the Treasury yield, has broken key resistance level of 4% this week. Still need to see whether it ends the week above 4% today. But technical indicators, and that includes chart patterns and Fibonacci retracement levels, are arguing for further upside in the near term, very near term, with the next resistance around 4.11%, followed by 4.25%. In our view, waning near term recession fears and surprisingly strong inflation that I talked about were key factors behind this yield reversing its prior downtrend. If you recall, the yields were downtrending earlier this year, at the start of this year. The upside pressure that we now see could persist if data continues to signal strong economic growth. In fact, the few data points that are coming up very pretty soon is the February US non-farm payrolls on 10th March and the inflation, this is the consumer inflation data, CPI data on 14th March. Money markets are now expecting a 25 basis points of rate hike by the Fed at its 22nd March meeting, followed by another 25 basis points of rate hikes in May and June before the Fed pauses. This implies almost 25 basis points of hike more than prior Fed projections. So we need to see what the projections show. The bond yields that I talked about could peak if Fed maintains its prior rate projections, or it could go slightly higher if the Fed aligns with the market now projecting for a 5.5% terminal rate. However, I should emphasize that we could continue to view the rebound in bond yields as more tactical than fundamental reversal. We continue to expect a US economic recession, as I laid out the case earlier, as a result of the Fed policy tightening. This, in turn, is likely to eventually cap bond yields as the tug of war between the higher policy rates and the prospects of slower growth are ultimately dominated by the latter. We continue to expect yields to move lower over the year. This suggests extending average maturities in our bond portfolios, and we are tempted to use the spike in long term yields as an opportunity to add exposure to the income asset class.
Okay. No, I think clearly a lot of opportunities emerging, especially in the US from the macro outlook. But on the other side of the world, we have a significant policy event in China in the form of the NPC. Uh, in your view, what should investors be focusing on in terms of what emerges from this important policy event?
Yeah, China, as I said, is a key part of our what we are looking as a core part of our portfolio this year. The China's the National People's Congress that starts tomorrow, literally, is has always been a closely watched event. It is especially so this year, given the appointment of a new set of leaders. Uh, we should be focusing on a few things. So the first one is the growth target. The policy priority of the government remains on reviving growth and domestic demand. This is what President Xi told us only just a while ago. Uh, and so the growth target we expect at least to be set at 5% or higher than 5%. Now, the second thing is policy reforms. Policymakers are likely to use the event to announce a wide set of reforms, and these include, promoting the key focus areas like green development, green energy development, that is, boosting self-sufficiency to ensure supply chain security, and further opening up of capital markets. The third thing we need to watch is fiscal policy. With growth being a top priority, fiscal policy is likely to remain expansionary. At the same time, government is not going to go overboard. It's going to still maintain the discipline, fiscal discipline. So the consensus is expecting budget deficit to increase slightly to 3% this year from 2.8% last year. And this is going to be targeted towards strategic industries. And by that we mean semiconductors, energy, artificial intelligence, robotics, and upgrading rural community infrastructure. And the final part of it, this is the monetary policy. We expect monetary policy to stay accommodative. And the other thing that we need to watch is the appointment of the PBOC governor. They will have to name a new PBOC governor. One of the areas that they are focusing on is probably the property sector. So we need to see whether that policy, the monetary policy, is tweaked further to encourage first-time buyers into the property market to revive the sector.
Okay, and perhaps very quickly before we close, I mean, a lot of what you described, is that consistent with our own house view, positive house view on Chinese equities?
Yeah, we believe the markets have largely priced in some of these expectations. However, we shouldn't rule out the possibility of a policy bazooka, which could drive risk assets higher. China's economy, as we have been saying, is rebounding strongly after the removal of the mobility restrictions, with the official manufacturing PMI and the rising to its highest in 10 years. The services PMI also recently beat expectations. The value of new home sales, for instance, by the 10 biggest real estate developers, climbed 16% YOY. I repeat, 16% YOY, the first yearly increase since June 2021 after the policymakers expanded their support. So the strength of the recovery is very clear there. In terms of the markets, the Hang Seng Index rebounded strongly, recovering the psychological level of 20,000. If you look at it in terms of the technicals, we could see that we could see a test of the major resistance level of 21,300, and then followed by let's say around the 22,700. um, uh, at the same time, I mean, the downside, the supports are around 19,783, which is the intraday low since the correction started at the end of 2023. Ongoing geopolitical risks, very short term dollar strength, and concerns about new internet regulations could act as a near term headwind. If the resistance level holds, the index could test the 19,300 zone that I talked about, and that we have been talking about for a while. We would consider adding exposure to Chinese equities, and specifically in communication services and consumer discretionary sectors, should the index retreat to these levels.
All right. No, thanks very much for that, Rajat. So, if I can sum up today's conversation, I mean, the key messages I really took away is clearly based on a macro message, consider sort of fading the rally in equity markets, and take advantage of the opportunities in bonds. On the bond side, particularly, of course, given where yields are, while small moves higher are possible, we'd really be looking to take advantage of those yields. And Rajat, as you described, of course, in Chinese equities, that's where we continue to be positive, not only because of domestic fundamentals, but clearly on the technical side and our expectations from the NPC, which altogether should help, particularly the communication services and consumer discretionary sectors. So we'll end the podcast there. Thanks again, Rajat, for taking the time to join us today. And thank you, listeners, of course, for listening. As always, appreciate your time, listening into us. Hope you found it useful, and we look forward to speaking to you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.